up here. Come join the conversation. Maybe we should come down there.
Oh yeah, I like that.
Cool. Well, hi guys. For those of you who don't know me, I am Morgan Krupetsky. I run institutions and capital markets business development at Avalanche. And also for those who might not be familiar, we've been focused on tokenization and RWAs for quite some time, even back in the day when it used to be called STOs, for those who might remember. And so by extension, we've been kind of really, even now, focused on real-world assets and how kind of accumulation of this technology, tokenization, blockchain, smart contracts can really help to upgrade legacy financial services infrastructure and processes and ultimately create new markets and capabilities. And so for those, how many of you guys have been to like crypto conferences before? Raise your hands. And how many of you guys have been to any panels related to tokenization before? Oh, a lot of you. So if you guys probably appreciate that most of those panels are very conceptual. They talk about process efficiencies and cost savings at a very high level. So we wanted to really use this opportunity to get a bit deeper and talk about exactly how and why we, as well as our partners, are applying blockchain to the financial services industry, really kind of understand the problems that we're trying to solve and concrete real-world examples of what you guys are all working on Avalanche. So to that end, we have 3 of our key partners here today to talk about all of this as it specifically applies to the private credit industry. We have Lily from Valinor to give us the view from the investor or kind of credit supply side of things, and Khibar and Juan to talk about the credit demand and infrastructure side of things. So we'll definitely hear from kind of both sides of the market. But before we get started, let's just level set a bit. Lily, can you just take a step back and just define, I mean, obviously the panel title includes the words private credit, like what is that? Give us a bit of a lay of the land. Obviously the term is pretty broad-based. It includes a lot of things. So from your perspective, just give us a mental model. Like when we say private credit, like what does that mean? How do you think about the space?
Totally. So hi, everyone. Nice to see you all. I'm Lily. I co-founded a private credit and special sits investment firm fully focused on the blockchain and crypto space. And exactly as Morgan said, I think people define private credit in various ways. It's a term that's used broadly. But to me, I would define it as direct to borrower, non-bank lending. So you're not syndicating out to the public loan and bond markets, and it's not a bank that's doing the lending. And that can be either corporate lending, so like loans to, commercial businesses, or it can be asset-backed lending, credit card receivables, factoring, things that are backed by hard or financial assets.
It's a very succinct definition.
Thank you. I tried my best.
That was great. So there's also like private lending as it relates to corporates, right? And then also asset-backed finance. And so we'll kind of hone in and dig deeper on actually for all of us a particular part of that and kind of why blockchain kind of helps to drive that forward. But obviously there's a kind of credit supply and credit demand side of the market. And you guys are all really at the forefront of building and kind of leveraging blockchain-enabled infrastructure to help drive things forward. So before we kind of get into exactly what we're doing, maybe Juan, if you want to kick us off in talking about in this private credit industry, what's exactly broken or inefficient today? So before we actually go into like the fixed part of things, for the benefit of, I mean, I came from TradFi, but I wasn't in private credit. So I learned a lot kind of as we progressed and worked together. So even people who are not in the institutional side of the industry, I'm sure they would like to hear as well. What are the biggest pain points that the industry has today, both on the supply and demand side of things?
Yeah, so I think what is broken, what we see broken in private credit and specifically in asset-backed finance is that the structures that are created for financing portfolios of assets, of cash flows, invoices, all the way up to mortgages, is that there's very intensive in operations, and those operations are usually carried by a very fragmented industry called the trust and agency service providers. These service providers usually use spreadsheets, PDF, emails, so very manual processes, which put together with all the complexity of those structures made it bring the big pain points, right? That, in my opinion, are mostly three, as I would describe them. Those are the operational inefficiencies. So all these manual processes are very costly. It required to have like a back office, managing those spreadsheets, communicating back and forth between investors, between the asset originators, and the third parties that are usually around. The fact that the information and those processes are slow makes capital move slow, which is the important part here. I think we can dive deeper later, but capital moving slow usually means wasted interest payments, capital sitting idle in different bank accounts, in different players, and higher financial cost. And the third point, I think, that affect lenders and investors is that there's poor risk management, right? Like the fact that the information is not flowing properly, the reports are monthly or quarterly in some of the cases, means that the covenant tracking and similar processes for monitoring the portfolio or the investment are processes that you see only after the fact happen, after things have gone wrong. So I would say those are the three big pain points in the industry.
So a lot of third-party service providers, all of which I'm sure take fees, and a lot of therefore manual processes like reconciling via Excel spreadsheets and PDFs. And Lily, I remember you came from BlackRock and you said you guys had, Blackstone, same, Blackstone, floors and floors of middle and back office people to manage all these things from your side.
We did, and one thing that I'll add is it's even more pronounced in asset-backed credit and asset-backed finance. And I think we're going to get into it in this panel, but that area is particularly ripe for application of blockchain because it is both an underlying asset base that can fit well into a programmatic buy box and servicing box, and then it's also exceptionally manually intensive because those third-party intermediaries and manual processes that Juan was referring to, those are all done on very small ticket items. So you're not going through a PDF of like one corporate borrower. You're going through a PDF or a spreadsheet of hundreds of thousands of individual credit card receivable line items. So it just takes all of the manual complexity up a notch. Like it's even some very large credit and asset managers won't participate in asset-backed finance because they just don't find that the operational burden is worth it.
Right. And to that end, maybe Khibar, if you want to kick us off in terms of, given all of these kind of manual processes, which therefore lead to inefficiencies, from your perspective, what does innovation in the private credit industry look like? What components of it, what components of this technology, whether it's blockchain, smart contracts, stable coins, where do you feel like kind of the innovation really comes? And I'd be curious to kind of hear the opportunity set from you, and obviously Lil and Juan jump in as well.
So I think if you look at private credits, right, besides the operational optimizations that you can do, the core of private credit is risk, right? How do you define risk and how do you engage with risk? And at that level, there is a little bit of a perfect storm in technology that is coming through. With stablecoin payments, you're able to go in and programmatically manage when you release funds, where funds are used, right? Using the transparency of blockchain, you can have a better oversight in how funds are used. You have an independent insight into this, right? And with AI, you can use all of this data to operationalize these insights, right? That allows you to fundamentally redefine risk, right? So I am very bullish on this industry, and I think the innovation really lies in this trifecta of automated blockchain, sub-second speeds, very cheap transactions, and you're bringing in programmatic payment flows. So asset managers that can come in here, besides doing all of the, the regulatory stuff, the operational stuff, it will allow them to rethink how risk is defined, right? And I think that piece can redefine the whole industry, right? Because you have a level of control, you have a level of insight, you have a level of operational information that, Web2 guys, they can dream about it, right? But not in a million years will they be able to be able to do this, right? So I think for us, when we look at these pieces, it's going a little bit deeper under the hood. It's defining risk. It's understanding where money goes, understanding what money being used for, right? Because at the end of the day, you are giving some money to do a purchase, to do a form of payment. And as those payments come on chain with stablecoins, all of these other pieces trickle in. And as AIs become smarter, the information around those payments become more intelligent. So I think as people with different skill sets come together, right? Because one of the challenges is for this to happen is you need someone who understands AI, you need someone who understands stablecoin payments, you need someone who understands credit and risks. But as these people do come together and they start putting these products together, I think it will change this industry on that core risk level. And then the operations and stuff will all come on top, but I think it will open up a whole new segment of assets on chain.
Yeah, I would say, I would add to that exactly having that stable coins for instant and programmable settlement across the globe, basically, so universal financial rails, put together with smart contracts that are those pieces of software where you can put all the rules of the game, right? With, to the point that Lily was making at the beginning, all these very clear and comprehensive set of rules of the game, actually, that are predominant in asset-backed finance, where you say what can happen or when can you do or request a drawdown and for it to be approved, what needs to happen when the money, when the capital, when the collections come back and you receive all the payments for financing a pool of mortgages, for example, are what makes asset-backed finance the perfect asset class for being disrupted by this technology, by smart contracts and stablecoin, which in my opinion is mainly what brings the blockchain in general.
To add on to that, I think, when we talk about the operational changes that this technology can unlock, we're not talking about, basis point savings. We're talking about, a fintech originator no longer has to take 10% of their balance sheet capital in order to bridge the funding gap and use that equity capital to grow. We're talking about firms like mine are able to participate in asset-backed finance, which we would not be able to do on traditional rails, just full stop. We couldn't afford to do it. It wouldn't be economical with all the back office lift. And so I think you'll see the market expand because it'll be easier for borrowers to grow. It'll be cheaper for them to, engage in their operations, not because the risk is being underpriced, but because it's actually being delivered with a better product. And then you'll see more lenders and, whether that's firms opening it up to retail participation, DeFi, there's a whole lot of other cool things that'll happen down the road. But broadly, I think it'll be easier for borrowers to grow and easier for lenders to participate. The market should grow.
Plus, that making that efficient makes it possible for new asset classes, new receivables that were traditionally not suitable because it was too inefficient to be financed or too small to be financed, to have access to these debt capital markets, which basically had been until today non-feasible.
I almost imagine the blockchain is a big Excel spreadsheet where all the different kind of parties can leverage the same standardized data set. And then smart contracts are almost just if-then statements, right? And allow you to programmatically check loan requests against the facility and then programmatically use stable coins in a way that increases the velocity of money, which I know that we'll talk about. So I think to your guys' point, it's a accumulation of all of these things, which makes it, to your point, Lily, economically feasible for investors like you guys to get involved in the space.
Yes.
So it'll be cool to see kind of, how that opportunity set expands. And maybe to that point, Khibar, if you want to kick us off, tell us about Axiym and actually how you guys are concretely using the tech in your day-to-day business, and the types of kind of companies that you guys serve. Let's start off with you and we'll go down the line.
Yeah, sure. First, comparing Avalanche to an Excel spreadsheet.
Like a much better, like an automated AI-powered super sheet.
With if and then statement.
It's the world spreadsheet. Is that good? Avalanche, the world spreadsheet. We'll keep noodling it.
We're in the lab.
Yeah. So at Axiym, we finance global payments, right? And a lot of the things that I preached a bit earlier, we use this technology to really first automate flow funds. We go in and we don't solve the problem of people not having money in terms of payments for global payments. We solve the problem of money not being in the right place at the right time, right? It's a distribution, it's logistics, and we use blockchain to automate that flow. We make sure money arrives where it needs to arrive. We have built our own AI agents that go in and every transaction does anomaly detection to make sure that this payment happens where we expect it to happen. This credit is extended in the right time, in the right place, in the right way, right? So it allows us to build an understanding of our customers.
Who are your customers?
Payment companies, so money service businesses, payment service providers, financial institutions, people who move money, right, across borders. They are stuck with FX, and I can talk about that for hours, but people who move money are always stuck with money being in the wrong place at the wrong time, right? So by bringing blockchain and stablecoins and AI together, we can understand them better, we can understand their payment habits better, we can build dynamic risk models where even if I've cleared you for a credit line, but there is a certain drawdown that does not fit a certain behavior, we can stop that, so we can manage risk in a way that traditional providers cannot, right? And we can be in the right place at the right time.
Juan, why don't you kind of expand on that as it relates to what you guys are doing? I know we're partnering with you and Valinor on something in particular, which you can talk about, but I think there's a similarity in that I think both use cases very much focus on increasing the velocity of money for the end customer. So why don't you talk a little bit about that?
Yeah. At Fence, we are building what we call the internet native debt capital markets, which is or has a lot of the features and capabilities that Khibar explained. Our product is an end-to-end debt administration platform for asset-backed finance. What that means?
Really sexy.
Yeah, exactly. Super sexy, boring industry that we are making a lot more efficient and internet native, basically, right? All the trust and agency roles, as I was explaining at the beginning, are consolidated and automated in this single platform. And what we are able to do is to take all the rules of the game that I always talk about in asset-backed finance, all the covenant tracking, all the eligibility criteria, drawdown requirements, cash waterfall, and we encode them in a mix of off-chain and on-chain software, or smart contracts in the on-chain case. And that's what we call on-chain structuring, right? We are not just tokenizing a debt instrument, a financial instrument, and creating a representation on-chain, but we are putting all the rules and making that smart contract to not only be a spreadsheet and saying this is the owner of 1,000 shares is Morgan, but we are also automating all the payments between Morgan and the rest of the stakeholders, right? That allows us to make things a lot more efficient. Our clients have 80% savings in operational cost, up to 30 or 40% savings in financial efficiencies. We can get it deeper now. And that is because all the processes that traditionally have been taking a lot of time, a lot of effort, a lot of cost, can be done now automatically, any number of times a day versus monthly or every 15 days, which allows us to, as we can get now into detail, finance or be a game changer in hyper-granular portfolios where velocity of capital is extremely important because if you have an asset or a receivable that it's 5 days long or 10 days long or even 30 or 60 days long and you spend 15 days holding it in your own balance sheet, then what's the point of financing it, right? Because it's been amortized before you actually get the capital from the debt capital markets. And as an example, one of our clients, we administer around 300 million in fintech receivables and 13 billion in more traditional assets like mortgages, is originating 100,000 different assets, different receivables every month, right? That would have been impossible with a regular spreadsheet. It is possible with a blockchain spreadsheet. And to that point, I'll let Lily explain what we are working on that I think is super interesting is putting that to the next level.
That's actually a good point. When you mentioned earlier, like what we're doing here is not tokenizing private credit funds and like trading them. That's like maybe will happen at some point, right? But what we're doing is really kind of getting into the weeds of the functioning and administration to even make the loan, to make private credit loans against a credit facility, which Lil, I know we'll review, but that's really like where, and we're using stable coins, right? So like that's really where like the power comes in. So Lil, if you want to kind of contribute in terms of, or add in terms of what we're working on.
Yes, was going to say, I think from our perspective, we think of if we partner with, partners like Juan and Morgan, can we be a more competitive lender? By using this technology, can we deliver a better product to our borrower counterparties by basically providing them better money that has higher velocity, easier, management, lower operational burden? And again, this is a market we're excited about from an asset class perspective, but it's hard for us to participate in without a solution like this. So, we got to know the Fens team, the Avalanche team, and we had previously looked at financing a company called OatFi, which we know well. They are a QED-backed embedded lending business focused specifically on B2B factoring and charge cards.
I love when people say B2B.
Oh, yeah.
B2B, B2B2C.
Indeed. They're quite scaled. They're doing about 500 million in run rate annual volumes right now. And we approached them with the idea of, could we give you blockchain-enabled capital? Would that be useful to you? And very quickly, they said, yes, this could really, especially for the short duration credit, the charge card type stuff where the average duration is, 15 days, this could really free up meaningful manual work instead of, every day having to sort through the charge card, like originations that day, and then figure out what is eligible from a manual perspective on our side, just have Fence administer that, and then we as the lender are also buying in. So it's a kind of turnkey solution with both the capital and the administration provided together instead of the kind of borrower and lender sides not being united on using the Fence platform. So we're very excited. They estimate this could save half a day of manual work every week for their team, which is, that's meaningful. Those are real man hours that can be put to growing the business in another way. And as Juan said, 30 to 40% interest savings, that adds up over time.
Yeah, and just to add on top of what Lily said, I think a big important part of what also they were excited about is what I was referring to before. They have existing lenders that are traditional, that are very, very powerful and very capable. And even with those lenders that are top of the market, they are not able to finance a part of their portfolio just because they are not fast enough. It's the traditional players cannot take a 7-day or a 10-day or even a 20-day receivable, right? So not only they are being more efficient with their traditional funding lines and financing structures, but some stuff that they had in their balance sheet or financing in a very inefficient way, now they are able to finance that and unlock all the capital that they have locked, which is something also that venture capitals, from what I hear, like as well.
Totally. And one thing I'd add, and this is really credit to OatFi, when you think about how applications of blockchain in this real utilization sense have progressed over time, part of that is that with the increasing acceptance of stablecoins as a new financial markets primitive, and of course regulation will supercharge that, you have more like high quality borrowers that are open-minded to trying this technology. And, I think that's something that you've really seen move forward over the past 12, 24 months. And I think, we're not asking them to change their go-to-market with their customers. We're not trying to disrupt that, but, just that stablecoins are now something that Web 2 companies are like, okay, I should understand this. I should see if it could help my business. I think that's a very big part of the unlock here.
Yeah, and I remember, I think like at the end of last year, we were talking about Stripe's acquisition of Bridge, and we're like, oh, this is really going to put a sense of urgency and fire under the butt of a lot of these kind of companies. And I remember the call that we had with the head of capital markets there explaining kind of what they now don't have to do because of this solution. They their face lit up. And so it's really cool to kind of see the impact in the real world. And so to that extent, looking, let's say 2 years ahead, Khibar, let's start with you as we wrap up. What do you hope to see, call it in 2 years' time, with respect to the evolution of the industry, specifically around private credit and even just like blockchain-based kind of payments in private credit?
Well, it's maturity more than anything else, right? I'm hoping that all of the little bad project that is giving the rest of us bad names and making our lives harder, I hope they get swept off, and regulators get more comfortable, traditional asset managers get more comfortable, new tools. I mean, the work you guys do in bringing different people and different players into the ecosystems where you share knowledge and expertise and networks. I think as these mature, the ecosystem matures, it will grow. Like Juan and Liz meant, more people will come in, more assets will come in, more funding will come in, and it will start a new ecosystem, a new form of private credit. Maybe we can term it like 2.0 or something, but I leave it to you guys.
I'm looking at Juan?
Yeah, on my side, what I expect in 2 years is maybe two things: a maturing industry, an industry where two things happen. That is, blockchain and fiat rails, or the traditional business, are more blurred, right? That you don't talk, and this is something that we made our decision from the very early and said, we are not talking about blockchain, we're talking about solutions, and talking to the banks or asset managers or private credit funds team that it's not blockchain related at all. We're just selling the solution to their existing problems. So I hope in some years that when you talk about a solution or an application or a protocol, you're not talking about blockchain, but you're talking about that specific thing, in the same way that you don't talk about what backend technology you're using or what database you're using, right? So that's one thing. The other thing I would say, that people or that the industry realizes that without blockchain, they're going to be less competitive, that there's more and more Valinors of the world that make their offering more competitive, and the traditional lenders, the traditional players that are not using this technology feel behind and start to adopt it. I think that will be a very interesting thing that will happen 100% sure.
Yes, I would echo Juan's second point for sure, and would also add, I think I'm really excited about getting to the stage of tokenizing the underlying assets, in addition to having programmable, so tokenizing flows, having programmable money, service and administer how these assets are financed. That you also have, if you're tokenizing the assets themselves, can you allocate them dynamically, based on a real-time risk model? Can you trade them dynamically, in a like DeFi marketplace setting? I think you're going to start to see really interesting capital formation and allocation implications of that'll like unlock a whole bunch of new cool things.
Awesome. Thank you, guys. Appreciate your time, and thank you guys for listening.
Thank you.
Thank you, Morgan.